Kalispera Anthropos. Welcome everybody to OIKONOMIKA, all about economics and finance. And yes, it's a special edition. I'm adventuring into a live streaming, which I'm not really used to, but I won't be long, that's for sure. And Viva la Quinta Brigada. It's a wonderful song, wonderful Irish song. Anyways, so I want to share with you all my own econometrics work, my own modeling, and I think I need to clarify a few things which I don't agree with for what concerns the OBR projections about the UK macroeconomic framework, the fiscal policy, so forth and so on. Because as I said in my other content, it seems to me that they either want to fudge the numbers and so paint a certain picture, or otherwise their modeling, some sort of this stuff, is not as good as my econometric modeling. And I want to be again so humble, but I'm very sure that the quality of my econometric research is probably more accurate than some official documents. It can be the budget, the OBR. I haven't seen the IFS, but I get to totally different macroeconomic projections, which then, not that they become a concern to me, but I don't agree with what I see in the official documents, in the official projections or working papers of these institutions. And it's not the point that I don't agree with this or with that. The point is that projecting a different thing, it means that you have a completely, you may get into troubles because you have a completely different assumption on what is going to be your the economic growth or the unemployment rate level and your fiscal position down the line in 2, 3, 4 years time. And then that becomes a real life problem, and that is going to hinge or also on the fiscal sustainability, because there is another thing which it's becoming more and more of a topic of discussion, is that the fiscal sustainability among the largest advanced economies in the G7, G10, it's again approaching some critical levels, and so that's among the reasons why, for example, the UK yield curve term premia has diverged for the past 2 or 3 or 4 years. I would argue since the Brexit referendum, from the Eurozone, and even the risk premium of term structure of the gilts market, it's even riskier than the US Treasuries, and we are comparing a 2.8 trillion economy with a 30 trillion economy and a 37 trillion dollar public debt. So the debt to GDP ratio of the United States is way higher than the UK, but for some reasons, probably because of the dollar, the risk premium of the term structure of the gilts market, it's higher than the treasury market. So there are also some well, you would say idiosyncratic factors of country by country features. So the first thing that it's worthwhile to make clear, it's what I said also in the last video, is that in Britain, okay, there is because it's a medium-sized open economy, it necessitates a lot of inputs from outside, and mostly because all our economic frameworks are all based on services and consumption. Okay, so we could make a whole discussion on how we so just to conclude, my research shows me that the natural rate of not the natural rate of unemployment, or the Nairo curve, so the non-accelerating inflation rate of unemployment, so the level at which people are in work but it doesn't generate inflation, so that the aggregate demand is not out of balance with the aggregate supply. So the blue line here, but also here we see in the unemployment gap, the blue line is the actual rate of unemployment now in the UK. So it's at 5%, 5.2%. And the projection tells me, the projection shows me that because also of the trend and the past autocorrelation of the same data, there is the risk that the unemployment rate, given some other conditions in the economy and in monetary policy or fiscal policy, so forth and so on, and in the global economy, the unemployment rate could be at 5%, even higher, even 6%. So there could be a scenario where you have an unemployment level shock in the UK economy, which completely contradicts the budget OBR forecast of the unemployment rate declining to 4.1%. 4.1% unemployment rate in the UK is the lowest level on record, and it was only achieved with zero interest rate, full-scale QE, etc., etc., etc. So there is no way with the current monetary policy framework and fiscal policy and all the other global economy factors that unemployment by the end of the decade will be at 4.1%. Not that I don't want to, but the condition in the economy, they make for me very difficult to see how unemployment is going to decline to 4%. I'm trying to find that ominous table that shows the difference of work between the OBR and the quality of the Bank of England. It will take me a little while to find the projections. Oh dear. Oh, this is so annoying. Well, I don't find the table, I don't mind. Anyway, it doesn't matter. We can use the budget figures and it's the same. So, this kind of projections and the level of employment in millions, probably the they are not going to be real in 2, 3, 4 years by the end of the parliament. And I say that there is actually the opposite risk, that the unemployment rate rises or increases to 5% and even more. So as of now, the unemployment gap, it's positive, it's in the red shaded area, which means that there are more, the unemployment rate, it's a bit higher than the black line, even the red line, which is an HP filter Nairu. So it's even it's another sophisticated method that it's smoothing out the into a curve, the unemployment rate, hold the data. That's 1989 up to 2025. And the blue line is the actual unemployment rate that you can find on the ONS, or it comes up on the telly. They will tell you, oh, unemployment is gone up, down, etc. So what that means is, in the real world, that there are more people that are not working. They are not working for an income. Okay, and so you need more fiscal stabilizers, which are basically absorbed into the welfare state payment. And so if on my projection the unemployment rate will stay at 5% and it can even be 5.2, even 6%, then that creates whole sorts of pressure in the automatic stabilizers that come from the social security net. So the welfare state or the fiscal position will have to spend more in fiscal stabilizers, because unemployment, you see here, I have a shock at 6% and then it goes down the line. So by 2028 it will be back at 4%, which could be in line. No, that's the shock. I'm wrong, sorry. Inflation forecast. Oh, that's the unemployment gap. Okay, yes. So there is a higher shock in the unemployment gap. So it means that the unemployment gap will be higher. Potentially, unemployment could be increasing above 5%. Okay, so I say that I could be making mistakes. So anyway, my own data, they are not showing me that the unemployment rate will decrease to 4%, but that potentially the unemployment gap could expand a little bit more and then decrease slowly in the following years. But that doesn't show me that the unemployment rate will be at 4%, and that's only one variable. Here, for example, you see what is the projection of the inflation rate, and it could be declining to 3.5%, but then eventually it would be rising again, or eventually be around 3.5%, in a range between 3.5%. So that doesn't mean that in 2, 3, 4 years time inflation will be converging to 2%. So there are many variables which come out in many models that I have, many projections, which are not really are very far in the future, but to me they are not really comforting, and they are not my work is completely, it gives me completely opposite results from what are the government projection or the OBR projections. So for this reason, I'm really careful in what I see, and what do I expect to be the UK economy in the future. I really don't know, but I'm not sure that the fiscal sustainability of doing public spending now and then backloading or postponing the higher taxes or just freezing the fiscal threshold would put things together would in the end balance the budget. I'm not really sure, because as I said, the unemployment trend and the inflation, it could be, is on a downward path, but the labor market, the data that I have don't show me that they are not really comforting. So what do I have is that the unemployment rate could tendentially, even the unemployment gap could get so high as here. So you will have a 1% or more in unemployment gap. So if the Nauru rates, it's 4% or 4.2%, a 1% gap would mean that the official unemployment rate will be 5.2%. And that becomes an additional expenditure for the government fiscal stabilizers. And so also GDP will not, economic growth that you are expecting to see will not materialize, and so the tax intake will not materialize, and in the end you will find yourself that you have front-loaded 7.4% in investment, in public sector investment, and then the year after, that's this data, where is it? Here, general government investment in 2026, the government is expecting to invest 7.8%. This percentage as a main component of gross domestic product, and 2027 another 5.4% in investment. So what basically every person knows is that the Exchequer, their philosophy, their idea is to do investment now and then try to tax later. But that is not a certainty that the fiscal position will be balanced in 3-4 years' time. Because front-loading the spending, it doesn't mean that you will have higher GDP or that more people, you will have 1.2 million people more in work. Because there are other data which prove me, for example, that the fiscal multiplier in the UK economy is slightly negative. So it is a matter of paradox. The government can do fiscal spending, but actually cannot be so good for economic growth. The multiplier is negative, so it ends up not generating the expected outcome. So what I'm also trying to say is that by front loading all this spending, I'm not so sure that the fiscal the fiscal buffer that they pretend to have, it will be so stable or so ample, so wide, like 20 billion in fiscal buffer, because there are all sorts of pressures. First of all, it can be unemployment that will require more stabilizers. But then it can be inflation, which will not go to 2% very quickly. And there are so many other factors. But here another thing, for example, is that the unemployment and the inflation correlation, it's very much pretty flat. So as I said, it's quite the opposite. When there is high unemployment in the UK, the inflation, it's persistent. You have high inflation, and slowly unemployment starts to creep higher, to go higher. It's not the case that you have a typical Phillips curve behavior. Is in fact here the slope of the correlation line, it's pretty much flat. There is no sort of unemployment inflation dynamic. Here these charts are very interesting because in very simple terms they explain you, for example, you see here how GDP growth and again the unemployment rate are correlated. So the higher GDP growth here with a lag of 2 quarters it's an indicator of decreasing unemployment rate in this slope. But here the slope of the line is not so steep. So higher economic growth, it's good for people. Naturally, it leads people into work, but it's not so strong of a factor, let's say. And here we have the interaction between the policy rate and inflation. That means like when the Bank of England starts to what has been doing for a while now, it has a monetary policy not reaction, but it tightens monetary policy. So what is the pass-through effect between the policy rates and the inflation rate? So it takes at least 2 quarters for the policy rate to, for example, to make inflation converge to 2%, or at least to change the slope of inflation. And then you see that, for example, by restricting money supply, inflation would slowly decrease. But these are all very slow process. It takes a long time. And also here, the wage inflation spiral, you see that there is no strong correlation between the level of wages and the level of inflation. What happens is that the level of wages are more a factor for the cost push factor vis-a-vis the productivity, and then what is the outcome in the GDP growth. So level of wages, they are not a strong indicator for the level of inflation. The level of wages, they are a good indicator for the cost push factor in short run aggregate supply, and what then are the the interpolation between the total factor productivity and economic growth, so that you can have a wage which increase the cost of labor, but then you see that the economic growth, it doesn't catch up. You can have a sluggish quarter-on-quarter GDP, 0.3, 0.4, let's say, but then wages, in real terms, they go up. But then you have a cost push factor, which make then not so affordable to employ people. So there are, all in all, what the unemployment, the Phillips curve, and the wage and inflation, they clarify the fact that except for very high wages, but most of the population, they are all more or less in the same average yearly wage. Even either the level of unemployment or the level of wages, they are not very strong indicators of inflation for what concerns the UK. But the level of wages, for example, they are a determinant factor for productivity and the cost push factor in the aggregate supply. And so you see that you can hike wages, but productivity, it doesn't catch up with higher wage, and so doesn't economic growth. So that's why I don't see these tables, the government expectation for their fiscal policy may not be so material in the coming quarter and years. So yeah, because here unemployment gap, it's projected to be 1%. So the last time, it's here, past 2020. So definitely the projection of the same data, they provide some more than 5% in the unemployment rate, at least in the coming quarters. So here we have some very small numbers where total factor productivity growth, it's negative. The average total factor productivity growth also is marginally negative. So it's actually true that productivity growth in Britain, but also I believe in many other countries, it's not so great. Those are among the factors that don't make economic growth so buoyant as what policymakers would expect, hopefully, to be, so that they can say, okay, my gross domestic product, it's growing more than the deficit, and so the debt to GDP ratio is okay. So I have so many things, so many models, that I'm just going into the studying of all the results. But at first scratching the surface, you can see here how the fiscal multiplier at different horizon, in 10, 20 quarters ahead, it's negative. So that scares me a lot. It says here that, so basically, that's this proportion, it's a bit not so good, but for every 1% of government spending, if the fiscal multiplier it's minus 0.21, we would theoretically argue that it's a negative for GDP by minus 0.21 or something like that. So what it means is it's through the inverse, so that because the fiscal multiplier is negative, a tax cut is positive by this coefficient. So that it means that a tax cut would be positive for 0.2% of GDP. So in simple terms, another thing that it's concerning to me is that they can try to do a lot of fiscal spending, but the thing is that they are not explaining why they have to do this. Okay, and I'm not sure it's clear to them, because the reasoning by ideology is not the same as trying to empirically understand things. Because we are in a late cycle economy, and we are past QE, we are past zero interest rate, we have higher inflation, and we know that the real business cycle it's a bit it's slowing. Okay, there is a bit more difficulty for businesses to create jobs and to hire people. That's due also to the continuous tax changes in the UK. So also the instability from a fiscal policy standpoint. That's what the IFS says, which are way more reputable than me. They have a lot of expertise. What they say is that because any chancellor comes in and make chops and changes what was done before, this complete instability and volatility in fiscal policy, it makes way more difficult for any business to make a coherent 2, 3, 5 year business plan and say, okay, now I settle here and I do my business and I can do this, that, and the other. Because fiscal policy it has been changing all the time. So the thing is that any government now, we can see also in the Eurozone, there is a lot of focus on fiscal spending, because it's basically it's the last tool in the toolbox that we have before basically we go into a big recession. So what basically the Labour Party, what this lot, they are forced to do, they have to do a lot more public spending in order to keep the economy going, because the real business cycle in the private sector, it's struggling. Okay, so the only way to keep the economy afloat, to have the economy doing GDP, it's by doing more fiscal spending, more public spending. That's why there is all this the reason, or explaining, say, we want public-private sector, and so we want that the government is more active into the economy, and so we want to spend more. That's the ideological side, but the mechanical side of what in real terms is the business cycle is that basically the private sector it's maxed out, and it's increasing more spending into AI, for example. But as also the Bank of England said, there is hundreds of millions which have been allocated into AI investment, but then the discounting, the present value discounting of the future theoretical cash flow of all this AI investing may be way exaggerated. So a lot of money which is put in now, probably it's gonna be wasted, and that's the another way to say it's a bubble. So we are in a moment where a point in the economic cycle when we see that all governments, they are forced in doing a lot of public spending. Why? Because businesses, they are not, unless it's AI, but they are not doing a lot of investment. Probably because there is no zero interest rate, or because there are no particular liquidity programs in monetary policy. Let's say we can buy in the open market AAA corporate bonds of all those corporates, but which are not in the financial sector, that kind of stuff. And so what the other day, the monetary policy stability report, financial stability report, having seen that, and in a pragmatic way, what the Bank of England has announced, they have the data in the economy, and they say, okay, the economy, its economic growth is struggling. Businesses are struggling also because of the higher fiscal cost. And because the government wants to spend, you have a crowding out effect from fiscal policy to the private sector. So what they said, okay, we are going to reduce the counter-cyclical capital buffer of banks. What that means that the Bank of England has allowed a bit more of space for the UK banks to generate private credit, so that to provide a money supply tool for businesses, and so to stimulate growth. That's what they said in the financial stability press conference. Okay, so anybody who listens and tries to understand, they explicitly say our measure is for growth, to generate economic growth. So at this point, you will have the government and private banks competing, and the private economy, not private banks, competing for funds. And I don't know what is going to be the outcome, but if I have to see one of the many models that I have implemented, what it shows me that the fiscal multiplier, it can be negative. So the government, they will say, okay, we want this because we are pro-workers, and so we want more state intervention. That's all pie in the sky. The real stuff is that we are late in economic expansion. We have maxed out with QE. We have all sorts of shocks into into the economy and society, so forth and so on. Unemployment has been going up for quite some time. There is persistent high inflation. Wages are not keeping up have not kept up with inflation. So what that means is that businesses, they are not so prone to do investment, because the cost factor of investing, it basically generates negative returns. So businesses, they are not investing. The only thing they do, they would like to get some AI, so some efficiency from AI. But other than that, they are not hiring, they are not expanding output. I don't know, the car makers industry, it's declining in output. So instead of expanding, some industries, they have been shrinking their production, because, I don't know, there is not enough demand for new cars. So we see that the economy, it's on a global scale, it has been slowing. The pace of growth, the pace of production, it has been slowing. The only thing that it has been growing is prices. So we basically, I want to because we are forced into an economic model which is bonkers. It's totally bonkers, because we can measure growth, economic growth. What is economic growth? Okay, because nowadays anyone would say, oh, I want economic growth, we will do economic growth, this, that, and the other. But what is economic growth? Okay, you can have economic growth with prices, or otherwise you can have economic growth from producing more stuff than the year before. Okay, so let's say, I don't know, it's ham, right? Ham and eggs. We have an economy which produces ham and eggs. Okay, so 1 year I have 10 packets of slice them. And here I have 10 packets of eggs. Okay, that's year one. Okay, and these are I don't know, $10. These are $10. Okay, now that's very, very simple. I don't need to explain anything, but by this I want to refresh the fact that inflation is the wrong measure for anything. So at the year 2, in the same economy, I can have the same number, 10 packets of sliced ham, 10 packets of eggs, but the price is $15. So what comes up is that GDP, you have GDP growth by simply measuring the difference of price between year 2 and year 1. And so the value added, the price change in nominal terms, let's say, basically shows up into the GDP. Then we have real GDP, so which discounts for inflation, and you have some sort of more real measure of the aggregate output. Now there is another way of having GDP, which is the most let's say organic, that the following year I have produced the whole economy, so all the people that go to work, even they don't go to work, I have 20 packets of ham, and I have 20 let's call it packets of eggs. What that happens is that if I have 20 and 20, but I keep the price at $10, the same, here GDP is $400. Here will be 300. I hope the math is not wrong. Yeah. So that's what any normal person would say, okay, probably it's better to produce more and to keep prices stable. So I don't need to raise prices because I have produced more for the same level of demand. Okay, let's assume that even if we are producing 20 packets of ham and 20 packets of eggs, then the whole population demands the whole thing. Okay, but at the end of the day, this one, it's larger than this one. Okay, so that's why we can, in our economic model, we see that prices keep going higher, but we don't produce more. So the aggregate amount of goods and services that we produce within, let's say, domestically within the economy, more or less, it seems to be always the same level of output. What changes is prices. While instead, if we were more virtuous and more rational, I would say, we would produce more, and at the same time, prices would be way more stable, and GDP would the pie would be larger, because aggregate supply of stuff expands, and so the price of ordinary staples will stay at the same level, but GDP here, we produce an aggregate value of $400 instead of $300 by just tweaking the price for the same quantity of goods that we put in circulation into an economy. So that's why what happens is that we print money, we do QE, we want fiscal spending, we want this, that, and the other. We want money, but we don't want to produce stuff. And then comes in all the arguments, etc., etc., etc. And in some sense, this goes back to the negative multiplier of fiscal spending, because if I do fiscal spending but I'm stuck on producing the same level of output of goods and services, well, what happens is that the expected sum of the future budgets, if it's a deficit, what that means that prices will have to adjust with deficit. The deficit keeps expanding and prices will keep going higher. So fiscal stimulus can be a negative multiplier and can generate inflation without achieving economic growth. Because why? Because we can print money, but if we don't switch on from having a fixed 10 packets of ham and 10 packets of eggs, and say, okay, next year I want to double my production, and so that prices are stable and the pie grows, because 2020 I have 200 of monetary value, which sums up 400 GDP, but here I have 10, 15, it's 150, and then at the end of the fanfare GDP, it's only $300. That's why tweaking the price is not real economic growth. It's just an adjustment in the price, because there is the same level of goods, but probably there is more money chasing around the same level of goods and services, and so inflation goes up. So what we are experiencing in the current economic cycle is that we have a lot of, not a lot, but there is a certain quantity of money, types of money, can be cash, can be financial assets, can be savings, it can be fiscal policy, etc., 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 that are chasing the same quantity of goods and services. So inflation can be higher or stickier above price stability for a certain period of time. The government can do fiscal spending, but in the end of the day, the fiscal multiplier is negative. So it doesn't come out any economic growth. The same example, it's abominous. It's the abomination of the Italian government. It's a total abomination. They are on course to receive more than 200 billion euro in European Next Generation EU Recovery Fund, etc. Now 220 billion euro, these are proportionally, more or less, give or take, 10% of Italy GDP. Now these geniuses which are in the government, which probably they still believe in Mussolini rather than in I don't know, any pragmatic and rational thing. I don't know what are their political beliefs, but they are so crap because they are politicians. They don't technically understand a dried fig. Okay, so you give them the shitloads of money and then they waste everything. So with 200 plus billion euro in recovery funds and next generation, Italy's economic growth, it's 0.3, 0.4, at maximum 0.5 or 0.6 per quarter, and you are flushed with 10% GDP in terms of liquidity, 200 plus billion euros, and you have to draw all the plans and all the projects that you are going to do, this, that, and the other, and in the end, it doesn't show up anywhere. So probably there are a lot of cases of money, of corruption, people who have stolen public funds, European funds, etc., etc. So that's why when it's politics who wants to decide how to spend money, this, that, and the other, it's always a disaster. It's an unmitigated disaster because they don't have the technical knowledge, the basic knowledge of saying, okay, I do this because the multiplier is this, or I know exactly what is gonna be the outcome, etc., etc., etc. They move money around because they need people to vote them here or there. So it's totally based on non-material outcomes, just to preserve power or to preserve their status quo, etc. So that's why using public money, you need to use it properly in an efficient manner. Otherwise, you can do a lot of fiscal spending, but if there is a negative multiplier in the fiscal spending, or the real business cycle does not need fiscal spending, or there are so many other conditions that you need, for example, a counter-cyclical fiscal policy, in a sense that you need to reduce spending because the tax you have to keep increasing the tax intake in order to balance the budget. So you need counter-cyclical fiscal policy. For all these sorts of reasons, we keep adding debt and deficits, and then we don't have the outcome that we think we're gonna have because of political party doctrine and because of this or that manifesto. I promised it this, that, and the other, and then the outcome is not. It's not 4% unemployment, or it's 5%, or not so brilliant economic growth. So I think I will stop now because I have so many so many models, so many data to go through. I am overwhelmed by the data. But here you can see, still for the UK, that the red line is the output gap. So they know that economic growth it's below potential, but you see how the blue line of the unemployment it's going up, and it's going to match towards the negative output gap. So you have these two things in the economy which are slowing economic growth and rising unemployment. Okay, so just now, just this week, they are trying to change, to steer the ship in a different direction, because they know that the Exchequer can do a lot of fiscal spending, or they can change the bank reserve ratio, the bank capital buffer, in order that so that the banks can do more private credit, because they see that unemployment is going up, and there is the risk that the trend in unemployment will keep rising. And so with that they will have economic growth which is not going to be 1.5%. And so what that means, as I said before, is that the fiscal position will need to spend more on the stabilizers, which means universal credit, what are called automatic stabilizers. And so all the mumbo jumbo of this, that, and the other is not gonna be in balance anymore, because they want to front load a lot of spending, and they are postponing the consolidation with the freezing of the threshold. But I'm not sure it's gonna work, frankly speaking. And I'm not an expert, but the reason why France has changed 150 prime ministers and they don't have a budget is because they don't want to do the fiscal consolidation now. They don't want to increase the pension age, they don't want to do this, that, and the other. So it's always the reason for the economy not to be working and not to be efficient, or to minimally work in a decent way. It's always because of conflictual ideologies, all these strange ideas, all this radical stuff, and then all the population there goes after this cacophony of no, I don't want this, I don't want that. So in the end you have politicians and the mass media, they end up in creating a lot of damage, a lot of problems in the socio-economic construct, because society becomes more and more unstable. You have more social unrest because ordinary people, instead of being focused on producing more pigs and having more hams and producing more eggs and having more hens and having growing more chickens and having more crops and stuff like that, they are more focused on ideas, and they follow this idea, that idea, and they clash for hot air, basically. And then there is nobody's doing anything constructive, pragmatic, practical. And so that's the main problem in the time that we are going through now. There is too much instability, social instability, institutional instability, and all the stuff that goes around. And then what are sensible, pragmatic things to do, they don't get done, because it's more important this election or that election, or this, who said that, who said the other, and doing the interview. And so I really, I don't. Anyway, the only thing I'm sure is that my models, they are way better than the OBR. That's for sure. And having said that, thank you so much. I've taken this great adventure in doing a live streaming, and I will update you all with my results.